Hi, and welcome to our 5-minute tax update for February 2019. We will start today's webcast by looking at some local tax developments. On the 5th of February 2019, Circular 32 was issued by the Tax Department, which explains the type of books and records that should be held by employers relating to benefits in kind, which should be made available as and when these may be requested by the Tax Department. According to the circular, benefits in kind should be divided according to their category as defined in the relevant guide issued in October 2018. There are two forms attached to this circular. The first form, which is Form TD 286F, should be completed by employers for each employee who receives a benefit in kind. It is divided into three categories, namely cars, assets and accommodation, and other benefits in kind, and includes all records that should be retained by the employers. The second form, Form TD 286A, should be completed when there are saloon cars in the business which are used exclusively for specific journeys between two locations. In this case, irrespective of the value of the car, the rate for the private use is reduced to just 20%. The form requires details of the cars used for this purpose only and should be submitted to the Tax Department in order to obtain approval for the reduced rate of the private use. The company's registrar has recently announced that a large number of companies have applied to be removed from its register. However, it has been found that many of these companies have various outstanding issues with the Tax Department, such as the non-submission of tax returns and amount of taxes due. Consequently, the Tax Commissioner is unable to give his consent for the completion of the procedure of closure. The Tax Department, in an attempt to be able to give its consent to the closure, has requested from all service providers and audit firms who have dormant clients or who have lost contact with their clients to submit all outstanding tax returns through an electronic file which has been circulated. The Tax Department has recently published the 10-year government bond yields for the following countries as at 31 of December 2018 for the purpose of calculating the notional interest deduction. In early February, there were also 6 tax bills submitted to Parliament with regard to tax-free bank loan restructurings, which extend the scope to include transfers of immovable property by parties related to the borrower. The amendments relate to the income tax law, the special contribution for defense law, the capital gains tax law, the stamp duty law, the collection of taxes law, and the land and surveys department law. Finally, on local developments, we would like to remind you that the obligations for contributions to the General Healthcare System, YESI, start as from tomorrow, the 1st of March 2019. Moving on to international tax developments, on the 1st of February 2019, the EU Code of Conduct Group sent letters to Barbados, Belize, Curacao, Mauritius, St. Lucia, and Seychelles requesting a commitment to replace their harmful preferential tax regimes with more acceptable measures so as to avoid being named on the EU list of non-cooperative jurisdictions for tax purposes. The jurisdictions had committed to amend or abolish the identified harmful regimes by the end of 2018, in line with EU standards. The letter informs the governments of the 6 jurisdictions that their recently enacted domestic legislation fails to eliminate the harmful features of the previous law and request a commitment to end the harmful practices identified and comply with the necessary criteria by the end of 2019 with no grandfathering provisions. According to these criteria, jurisdictions should not facilitate offshore structures or arrangements aimed at attracting profits which do not reflect real economic activity in the jurisdiction. On the 13th of February 2019, the OECD released a consultation document titled Addressing the Tax Challenges of the Digitalization of the Economy. The document sets out 4 proposals under consideration by the members of the inclusive framework as they work towards reaching a new long-term solution by 2020. The options under consideration are 3 proposals to revise existing profit allocation and nexus rules based on the concepts of user participation, marketing intangibles, and significant economic presence, and the global anti-abuse erosion proposal comprising income inclusion and denial of deduction rules to permit countries to tax profits where income is subject to no or very low taxation. We will close off today's tax update with a brief reminder of the deadlines coming up. 31st of March is a deadline for the electronic submission of income tax returns for individuals and companies preparing audited financial statements for the tax year 2017. This concludes our tax update for this month. Thank you for watching.